If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. The Philippines economy demonstrated firm stability in Q2 2025, characterized by strong GDP growth, declining unemployment, moderate inflation, lowering interest rates, and a contained government debt burden. These indicators combined to preserve macroeconomic balance, providing momentum for continued expansion while managing external pressures. The GDP annual growth rate remained robust in Q2 2025, with year-on-year expansion at 5.5%, slightly above the 5.4% rate recorded in Q1. This marked the strongest growth in a full year, and was underpinned by a sharp rebound in agriculture, which grew around 7% along with resilient household consumption, also rising by 5.5%. On a quarter-on-quarter seasonally adjusted basis, GDP grew 1.5%, signaling continuation of the expansion, albeit at a steady pace rather than acceleration. The unemployment rate edged lower to 3.7% in June 2025, down from 3.9% in May. This improvement reflected the addition of job opportunities in agriculture and consumption-sensitive sectors, even as underemployment and job quality remain challenges. Earlier in January 2025, unemployment was at 4.3%, underscoring that the Q2 figures represent a return to earlier lows, supporting labor market stability. The interest rate environment is becoming more accommodative. The central bank's benchmark policy rate was maintained at 5.75% in February 2025, with the overnight lending rate at 6.25%, among the highest in the region. By mid-2025, the key rate had been lowered to 5.25%, marking a gradual easing stance amid slowing inflation and stable growth. The central bank signaled readiness for further cuts, likely totaling 2 reductions through the year, in line with improving price conditions. Inflation moderated significantly. By January 2025, inflation held steady at 2.9% within the central bank's 2-4% target range. This trend continued, and by May it had eased to 1.3%, while July inflation dropped further to 0.9%, the lowest since late 2019. The year-to-date average inflation through mid-2025 stood near 1.7%, reinforcing strong disinflation. Core inflation likewise softened but remained moderately elevated, anchored by easing food, housing, and utility prices. Government debt to GDP remained under control. As of Q1 2025, debt stood at 57.3% of GDP, slightly above the previous year's 56.7%, reflecting modest fiscal drawdowns. By end January 2025, sovereign debt reached around 16.31 trillion pesos, increasing to approximately 17.27 trillion pesos by mid-2025. Yet early projections suggest the debt ratio will ease to 61% by year-end, enabled by ongoing growth and fiscal discipline. Key macroeconomic indicators at a glance. GDP growth, 5.6% for full year 2024, 5.4% in Q1 2025, 5.5% in Q2 2025, quarter-on-quarter growth of 1.5%. Unemployment ranged from 4.3% in January 2025 to 3.7% in June, low and trending downward. Interest rate eased from 5.75% to 5.25%, signaling monetary policy accommodation. Inflation declined from 2.9% to 0.9%, by July year-to-date average approximately 1.7%. Debt to GDP approximately 57 to 58%, projected to fall to around 61% by year-end. These metrics reflect an economy enjoying balanced expansion. Growth remains above long-term potential. Domestic demand drives activity, inflation is well under control, and monetary and fiscal policies are responding with restraint and flexibility. Drivers of this stable outcome include agricultural rebound played a large role in Q2 growth, reversing previous declines and absorbing rural labor. Household consumption remained a consistent growth engine, supported by easing inflation, strong remittance inflows, and stable jobs. Public infrastructure spending remained elevated, continuing to fuel growth in construction and employment. Exports and manufacturing activity stabilized, helped by improving global trade sentiment. Labor markets tightened, with job creation outpacing new entrants and keeping unemployment on a favorable trajectory. Policy environment has adapted appropriately. The gradual interest rate dialing supports consumption and investment without reigniting inflation. Fiscal policy remains moderate, emphasizing targeted infrastructure and social spending while maintaining debt sustainability. Central bank communication emphasized data dependency and responsiveness to shifting inflation and growth trends. External resilience persists. The current account deficit is projected to narrow to around 3.3% of GDP in 2025, with remittances projected to grow to $35.5 billion. Foreign reserves remain sufficient to buffer external shocks. However, potential risks include renewed global trade tensions, volatile food prices, and semiconductor industry uncertainties. A drop in remittance inflows or another surge in oil prices could challenge stability. Meanwhile, structural issues like underemployment and fiscal pressures from debt servicing remain long-term concerns. Policy recommendations to uphold stability and build resilience. Continue gradual interest rate easing as inflation remains subdued, while monitoring inflation expectations. Focus fiscal spending on quality infrastructure, digital innovation, and human capital to raise productivity. Diversify exports, deepening linkages in high-value manufacturing, agro-processing, and digital services. Support rural development and agricultural resilience to sustain Q2 momentum. Strengthen social protection and job training to mitigate underemployment and job quality gaps. Keep debt manageable with gradual reduction in debt to GDP through growth acceleration and fiscal reform. Preserve strong foreign reserve buffers and external financing access for balance of payments stability. If these strategies are sustained, the Philippines can maintain growth in the 5 to 6% range, push unemployment closer to 3.5%, keep inflation within 1 to 2%, and reduce debt to GDP towards 60% by 2026, building a resilient and inclusive economy. In conclusion, the Philippines economy in Q2 2025 displayed commendable stability. Strong GDP growth, falling unemployment, disinflation, early monetary easing, and controlled debt. Anchored by agricultural recovery and steady consumption, the economy continues as among the fastest growing in the region. Balanced policies and structural reforms will be key to preserving this stability amid external uncertainties and supporting the next phase of inclusive growth. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.